Weekly update of the U.S. stock market. I'm Rich Posson for Critical Point, and it is 1:19 p.m. Eastern Time, October 13th. Okay, first of all, let's look at some of the bull-bear investors' intelligent bulls and bears ratios, and we can see that it's quite overdone here to the downside of when we can put in some long-term bottoms in the market. They're just simply too bearish. This is something we will discuss in the future. It's a Bloomberg commodity spot index, and someone was just pointing out commodity super cycles and very long ranges of time that then lead to maybe a decade of higher commodities and also inflation. It's something we'll discuss more with the commodity side of the service, but it is something to think about in coming years here for our long-term stance on the stock market. This is what's called the Sticky Price Consumer Price Index. Federal Reserve at the Fred site shows this, and it just shows how the inflation has worked this year, and just shows concerns by investors as well as business people, government people, Federal Reserve. We're just not stopping inflation. This is a Consumer Price Index since 1940s. And you can see prices have always gone up. The CPI index has always gone up. We've always had inflation. It's only on a short-term basis, and short-term meaning over 1 or 2 or 3 years, that we've had some setbacks at times with recessions and other complications. It's the pace of inflation that actually slowed over the last 40 years, along with a decline in interest rates. Super cycle-wise, that's probably over, and we're going to have higher inflation rates for a few decades to several decades, right along with interest rates, but still don't believe it's going to be as severe as what we've seen in the 1970s. But look at what has occurred since the 2020 recession, pandemic, and as we zoom on this by clicking on 5 years, we can see what's concerning today is from August to September. It was a nice jump, new record high in the CPI index, and the percentage was just too strong, and they turned bearish and sold stocks. So let's turn to the interest rates before we get going on the stock market, because this terrible inflation report, is how everybody's calling it, certainly makes people think in terms of, well, higher interest rates still from the Fed, and we're still at risk of hurting our economy, and we're just not over on this war on inflation and economic problems for quite some time. And that may scare others into selling stocks, and so we might as well sell stocks too. Okay, so at least have to protect ourselves from the unknown of lower stocks. Well, that then makes them think in terms of any given day, any given hour. If interest rates are coming down, then maybe the stock market will go up some. And it has been a very good correlation this year. There are people saying that the way the interest rates jumped this morning off of the inflation report reminded them of early August, or I should say the August CPI inflation report. And I didn't quite catch on to that. I looked at their intraday chart and I could see interest rates exploding, but they didn't compare it to what was in August. They didn't show August. But this is what occurred on my interest rate chart for August. It just kept marching higher. And I wonder, is that what they're implying here? Okay. And so that can also cause problems for the stock market. Well, what's our model say in terms of the possibility of still higher interest rates? And it's saying, well, we met this objective a long while ago. We met it again a couple of days ago and then blasted through it today. Now it's trying to go back down. And yes, it can come down into a level 3 bottom next week. Okay, shouldn't really bottom this week. So does that mean they'll rally the stock market next few days? Well, the problem with that thinking is the model's also saying a new level 3 uptrend ought to be lasting out into the next 2 or 3 weeks. And we have new objectives around 4.14% to about little over 4.2%. And it's very easy to come up with calculations all the way up to 5.5%, depending on whether you're using the Federal Reserve rates as possibly also going to 4.5. Therefore, you would assume the 10-year note would keep at least a 0.5 point premium to maybe a point to a point, or 1.5 points, okay? And that's how you can get to 5% or higher in the 10-year note. Okay, so that's concerning to people. That's a long ways off. That's a lot of interest rate hike. Could still cause a breakdown in our economy and financial markets, a little crash, and that's concerns in the stock market from that perspective. At the same time, they're thinking, well, even if it wouldn't cause a crash, it is eventually going to do what it's going to do and could very well hurt some businesses and forward earnings and still give us some headaches, all right? So the bottom line is the model's saying, although it's looking good, like interest rates will now back off for a few days, and what it really is just profit taking in the bond market, okay? And they're flipping the other way a little bit. But I'm a little concerned we've already seen the lowest, and next week's level 3 bottom is actually going to come in within this range and maybe even a little bit higher. And this target's probably should be shoved further out in time. But the thing is, we still have higher objectives as well. So the bottom line is it could be in a trend like this, going up, and it just keeps moving higher like this, and it marches higher just like it did in August and September. And if we extend this trend out, it's almost back into that trend, like you can just extend higher like that. Well, it seems as though that would not be a good thing for the stock market. This is a 60-minute chart of the S&P 500 cash index. We have a gap here and a gap there. That was a bearish island reversal for the technical people, so they were bearish into the report. Fundamental people went along with it. And now look at this, the gap's lower this morning to be in line with the lower overnight futures that was in line with the bearish inflation report, meaning bearish for stocks. But notice this robust up move price-wise, and we took a look at the volume, and indeed it does look robust, like somebody really is bargain hunting and buying here. But why would they do that when we just got a horrible inflation report? Are they willing to say we finally hit an extreme? I don't think so. I think people are really nervous. They don't really want to talk to anyone who's saying a big drop in inflation. They've been burned too many times since June. So I'm a little concerned. This is just speculation, buying, bears stumbling over one another. There may be some bargain hunting here, but is it possible it's just people trading over the next few weeks, that they're willing to dial in a rebound in the stock market ahead of the Federal Reserve raising rates next month? But do we truly have quality long-term buying? Maybe. We've seen some of it. Somebody bought a fair amount of money, a fair amount of stocks last week. They put a sizable amount of money into the market. And yet that's been erased already. Have they backed out? Are they ready to buy more? Don't know. But one thing I wanted to point out is this gap may be an upside target. So it wants to return to, say, the 37.19 or something like that. Also, these levels that were originally downside levels, okay, can be actual upside levels to stop the market. Now, as I'm talking, it's trying to go to a new high for the day already. Okay, so this chart is delayed. It is getting overbought in a 60-minute chart. So at any rate, yes, I can't rule out a move even back to the high of this bearish head and shoulders pattern, about 3,800. But I think there's just going to be layers all the way up where they're going to ask themselves, do they want to continue to buy? Is it a moment to get caught up that they didn't sell enough on the way down and nothing has changed fundamentally, that we're still going to have an aggressive war on inflation? And so this is a 3-hour chart, and we're showing a level 4 bottom here, level 4 top. Even though it tried to take that out, it couldn't do it and went down. And yes, one scenario is this is a level 4 bottom, but it's really too late. It's a rule violation. But these level 4s stick to the definition only about 70 or 80% of the time. They only work well enough in terms of moving far enough to make some money out of them 70, 80% of the time. If you're a day trader, intra-week trader, you can make an argument, yes, it bottomed, and therefore it's probably heading higher into tomorrow on into Monday, and that there might have been a level 4 top buried right in there, right in all that quiet trade yesterday as they were waiting. Problem with this scenario is we can also make that a level 4. This is not a level 4. The market ought to actually go down next couple days, and it could even be topping for level 4 right now. So what's going on is the level 4 trader is still confused with what they want to do, but they're far more aggressive now that they got that data, and they're just comfortable trading their little 1-minute, 5-minute charts or whatever they're doing, and their computers swinging with the trade. Okay. The key is the level 3 trader, level 2, level 1 traders have also been a bit confused going into or just trying to rest into this report. Now they have the data, they should be less confused, but they really haven't done enough to clear up this very short-term pattern of whether we're truly seeing good demand or is this a fake out move, a knee-jerk reaction before putting the market lower? So this is the daily chart of the S&P 500 cash. They slammed it lower. This is the first day for a level 3 bottom, even though we have debate whether it really was a level 4. Got to have a level 4 with it. If not, this market can retrace in just the next couple of days here, put in the level 3 bottom, then rally. Due to the momentum and the fact that we had some good buying on the way up, good volume, far better volume on the way up than on any tick down, and also had this daily indicator was oversold and trying to turn to a buy signal today, I think it's best we assume we got a level 3 bottom in place and the market's heading higher into next week for a level 3 top. It can go to that 37.19 or whatever it is to fill that little gap. It may yet challenge 3,800, and we just don't know how crazy they might get on the bull side, but we should also keep in mind nothing's changed. If anything, things are worse today in terms of this war on inflation. The Fed ought to start raising a full percentage point. So I'm still questioning whether this is going to be a good level 3 rally and wondering what might go wrong. And what I can tell you is if it takes out today's low at 3491.58, I would be concerned at 3410 down to 3316, similar to what we showed you earlier in the week for the futures. And we even have the futures below 3,300, which means the cash would have to do that as well. All right, so yes, we have to consider it can rally back to this 20-day average. It can fill that gap in. Yes, it may even rally to 3,800, but we also have to consider it might settle back at any point, and we have to consider that if it takes out today's low, not a good sign for stock market bulls or anyone who's looking for several weeks to months and years of rally. It's just not there. All right, now this is the daily futures. Eliminate some of those gaps and some of the noise and stuff on the cash market. We're also getting a buy signal today if it'll close up and maintain this, and it was oversold and leaving oversold. So we have a right to have a little faith in the model saying it can bottom today into early next week for a level 3, mid next week. And this is looking so robust now that the odds are high it's bottoming for level 3 and it's rallying into next week. It's starting to turn the 5-day McGinley dynamic above the 5-day average. That's our latest technical study that we've optimized towards these level 3s per the model. Okay, and it seems to be working fairly well. So this may very well be a buy day. And until violation of a level of today's low, and in the futures that's at 35.02, I think we just have to consider a chance. This market's ready to rebound, and I think what's going on is traders feel safe that the Federal Reserve isn't going to give them any more complications and problems. Okay, in other words, no problems until maybe November, when they raise raise their rates and then have a little discussion and whatever else they can give us. But there can be comments by Powell and other members of the FOMC along the way that might cause problems. And there's still going to be other economic news, business news. We still have earnings to deal with. So I just don't know how much to trust this, but it's looking pretty impressive that they bought such bad news. They played the game, and now it's acting like they just don't want to play the downside right now. But, you know, is it sustainable? This is a weekly chart of a fund, a symbol RSP, and it's an equal weighted S&P 500. Sometimes can give us a little different indications. And I'm thinking it's possible this, what's now looking like a positive reversal. I mean, actually opened higher, slammed lower for the week, and now it's coming back. And we're getting an oversold indicator trying to turn to the buy side. And we can make a case this could be a level 3 pattern from 2 weeks ago into this week. And make a case it ought to be higher into next week at least. And how about our idea when we were trying for a level 2 business cycle, a level 2 downtrend, and an end to all that, a bottom. All right. So we have to consider this different way of looking at 500 stocks can be showing us positive indication. All right, here is the weekly chart of the S&P 500 futures that we've shown you every week, if not far more often. And it's the same story. It looks like, yeah, they got a little positive from last week into this week, then slam dunked it, and then brought it back, and now it's even above the open of the week and above the close of last week. That's looking pretty constructive. Folks, I think what's going on here is this may very well be a level 2 bottom, and then this is a level 1, and we just seen the lowest of the year. But for the way this inflation stuff is developing and the interest rates and what the Fed could do in the next week, I don't think that's the safest story. So I think what's really going on is I've reverted back to the original call of level 1 bottom here, even though recently I said maybe it's only level 2. And this suggests the market's actually trading rather normal for level 2s, level 1s. So what this is suggesting is it's coming into a level 1. Coming into a level 2. It can bounce now for a level 2. And the point is, it probably shouldn't top the next week or the following 2 weeks, meaning we might see some upside strength, some support here after all. But it's looking like the October rally isn't going to be what we were thinking of 1 month ago, 2, 3, 4 months ago. There's just too much destruction here. The fundamentals are too poor in the sense of the inflation, the macroeconomic side. Business-wise, unless we get some poor earnings here, a lot of poor earnings in the next few days, couple weeks, business-wise, looks like the country's doing great. The economy's just rolling right on. And if anything, this market is dirt cheap compared to what the economy's doing. But the problem is we got this war on inflation. We got this rising interest rates. Who's going to win? Okay? So I'm thinking we might get a bounce here into next week. Maybe we find out it sets back and goes still higher right in the end of the month. And then it sets back sometime in November for a level 1 bottom. And ideally, it would go lower than this week if this is a level 2 bottom. And by the way, this is the last week I'm allowing for a level 2 bottom. You bulls better make this happen, get this going, put it up there. This vertical line is reminding me of a time stop. If the stock market's going lower still for the year, next week and a little later, we need to assume it's going lower into that bottom in November that now may not even show up until December. In fact, if this is the level 2 bottom, we're going to do a revision. In fact, I guess I already did it. Let me adjust this a little bit, make sure you understand this. This is the most recent, that was the recent, that was a calculation we were using weeks ago, but we delayed it some to keep up with the market. So in theory, it would bottom there. The problem is that's hinged upon that we originally called on the week of September 5th, we called it correctly. It was a level 2 bottom. The market rallied into the next week. That's the minimum needed. And then it got just destroyed by jobs and inflation and everything else, and they just turned bearish on us, okay? It's possible if that's the level 2, this market's going to bottom in early November to late November. But if by chance this is the level 2, which is the latest we're allowing, we would have preferred that it didn't go any lower than last week's low, but we're willing to allow a little gray zone, if you will, for that last minute low. But we're then saying, no, we're going to draw the line in the sand of next week. The bulls got to get this going or we're in trouble here. Because if this is truly a level 2 bottom this week, then it won't bottom to near Thanksgiving into December, and ideally December. Either way, we can make a case that this market can drop 3 to 4 to as many as 8 weeks. I don't think it'll really drop that long, but what I'm concerned is it can drop hard and fast early, any moment now, put in some kind of floor price, and then flounder around into the bottom that may not show up as soon as December. Okay? Or I should say in December. So a couple of scenarios there. If it only rallies for a week or two and turns abruptly bearish and gives us a lot of problems going into the November rate hike and maybe the November CPI inflation report, we should just assume the scenario that we had it right in September, doesn't matter, and we want to look for that level 1 bottom in November. If, however, the market stays up longer than we think, doesn't come down so severely in early November, then maybe it's going to come down into December. Now, we've also looked at the minor long-term business cycle. First of all, let me wrap up what's going on here. Resistance would be last week's high, near 38.20, in other words, near 3,800 for the cash. And it's unlikely to have more than 1 to 3 weeks to move higher. Okay? The 5-week averages, open and close, can be nearby resistance. We'll go with the highest one just to be safe, and it's right around 37.98. So again, resistance can be around 3,800 to stop it. That may be the best we're going to get for our October level 2 rally, because the market is just going to keep working lower all the way into December. Or it's going to work lower in early November, and maybe we get the rate hike, and maybe we get the Federal Reserve to give us some encouraging information that they may be willing to stall, that they see some light at the end of the tunnel. It could be that kind of scenario that then could add some bullish December into January. So that's what we're up against, is that we have this idea of a bottom either November, December, and we should know in just a few weeks how that's going to develop, but both scenarios do allow for at least a bounce into next week. That may be all. Now, how about the long term? We know we have a major bottom in 2020. It's a once-a-decade bottom buy signal for the stock market. We knew the economy bottomed a little while afterwards for the same type of cycle called a juggler business cycle, and in theory we have economic growth all the way to the end of the decade. Inside of that, there may be what's called an LT2 that can show up in 2025 and perhaps delayed to 2027. That can cause some significant downside as well. And then you'd have your final leg higher into the end of the decade. We've also noticed that inside of that, and therefore inside of that major long-term bull bear market, are 4 to 6 minor long-term business cycle bull bear markets. And so one began right along with the LT2 and the once a decade buy signal LT1, but the LT3 topped in January, a little earlier than we wanted, but we caught it on the way down. It was still close enough to say we caught the top. It just wasn't the timing and precision that we normally are capable of. And then we caught a bottom in February as the first opportunity for a long-term bottom. Then we realized the inflation stuff was getting more serious on us, the Russia-Ukraine, and we turned bearish on the way down. We caught a few twists and turns along the way fairly well. We caught a bottom in July later than we wanted relative to the June bottom. We were fine with it. We got a very nice rally, very good demand. And then we found we had to give up after all. So we've had 2 opportunities for a long-term bottom. They didn't work. I'm willing to call those strikes, 2 strikes. We're now going for strike 3. And we have a scenario when maybe 1 out of 3 scenarios suggest maybe it can bottom now and we don't realize it for a minor long-term. But it's leaning now, thanks to today's data, inflation stuff, it's leaning more likely the other 2 scenarios saying a bottom November or December. And in theory, that's the latest that ought to be for this bear market, for this bull bear cycle. And we ought to start a new bull cycle for 2023, 2024, meaning eventually we will win the war on inflation. Now, some of you have asked, but what might go wrong? When's the absolute latest? Well, I have coming up with a weird alternate scenario when, yes, it ought to bottom no later than November, December, with a slight chance of bottoms now. But originally, back in December of last year, we said this thing might not bottom to the start of next year, 2023. Well, we've come up with a scenario that's the absolute latest of February. And what do I mean by absolute? In March or later next year, if the market was going lower still compared to this year, we're going to have to consider something that hasn't occurred maybe in 50 to 100 years, but has occurred. And that is, we may have a very weak rally in 2023 to 2024. We may have a setback earlier than expected that would show up in 24 instead of 25 and even be negative into 2025. We could have problems and complications when that larger level LT2 business cycle, in other words, combining 2 of these LT3s, just didn't work well. This would probably be lingering inflation fighting for a few years to come, or we overdo it in the market, or an asteroid hits the earth, or a World War III is far more serious than the other wars, because the other wars, yes, it caused problems immediately for the stock market, but later the stock market did very well during the war and after. Okay, in fact, there was more problems after, as we bring all the troops back and have to find jobs for them. Okay, so the bottom line is there are things that can go wrong here, that we slug it out for a few years, but it seems such low probability that I'll set a time stop in March. Don't know how much I'll trust it, but if we're having problems later next year, we're going to have to make some big revisions for a few years at least, but it still will not negate the possibility, probability, plausibility, feasibility to move higher for this decade. And this just brings us back to the best scenario is it ought to bottom no later than February, but ideally inside of that it ought to bottom November, December, with a slight chance of bottoming now. What would give us a clue it's bottoming now? Well, we'd have to take out this year's high at 3806.91 on a very convincing basis, meaning much higher than that, and for a while higher than that. Otherwise, we really won't get a clue that we're on board to our major long-term or our minor long-term bull market inside of a mid-size, inside of a major long-term bull market, until it trades above 8325.28, or basically that 4300 level that we were discussing months ago. It's going to take that much of an up move to really give us some evidence we're on our way, and by then that's high enough and long that you could see how we could get some developing news where we'll believe it. We'll want to do it. And maybe we'll even find news along the way that we don't want to wait entirely for that higher price level to get bullish. And again, I can fully understand why some are going to get bulled up if it takes out this month's high. But I'm concerned that this market's going to be lower in November. And I'm concerned it can come back to 3,500, if not down to the 3,200s, upper 3,200s, into the 33, 3,400s, into this little hiccup right there. And that was important. And we traded it well. And we stayed with our long-term bullish scenario, made a lot of money out of it. But it was tricky, okay? And it's going to be tricky now. So I'm staying what I'm showing here in this chart where we have these little boxes. November, December, I think is the better time for a long-term bottom. I don't trust this market to rally that well near term. I think we've got some issues here, that we've got headwinds coming. And so I'm concerned, and we're back to the daily chart now of the futures. I'm concerned we may be looking at a level 3 bottom right now, but we may learn just the next couple of days they slam it all the way back down, put the bottom in, bring it back up, but by then they're running out of time, and so it just simply does not work. There's no traction here, sustainability, persistency to hold it up. But if I'm wrong, then this thing can rally to 3,800, maybe even a little bit higher, rally into next week, then it starts down again, and then we will reevaluate. Okay? So I realized looking all the way back several months, I was buying any kind of a bottom for level 2, level 1, any kind of level 3 inside of that. And I realized I probably shouldn't let up and just throw the darts. This thing might rally much more than I think. But I'm really concerned this inflation report was just flat out bad. Okay, we're not getting anywhere. We're not winning. And I realize there's a lot of data saying we are. And maybe people are going to be more convicted saying, yes, but next month you'll see this thing coming down. But they've been wrong since June. And I've been wrong. And I followed what I thought were good people that knew what they were doing. And I looked at my own stuff. And I just do not trust the upside. I'm not buying. I'm still out of the market. And I'm going to be missing out here if it goes just a little bit higher, because I did sell some later than I wanted at a lower price than what I wanted. But I guess I'm going to grin and bear it. I realize this is oversold enough, and it's trying to turn to a buy signal right in line. I mean, if anything, the level 3 trader, if he can trade fast enough, he may win on this. But I'm just concerned for those who are going to wait a few weeks to see if they're right, going to wind up being wrong, okay? Or at least we're going to have a stagnant market for a while. My guess is they're going to sell this market by the time of November when the Federal Reserve raises their rates. And I'm just concerned they could start selling in a few days as the U.S. interest rate decides to rebound. So put me down with the idea that I fully understand why it can go into the low 3,700s to a little above 3,800, but I don't think it'll be any higher than that. Put me down that I understand why the market can rally into next week, but I also understand something might go wrong. It just won't work that well. I think if you start seeing it trade back below the open of today at 35.96 and a quarter in the December S&P 500 futures, they're going to get really nervous of a negative daily reversal. Even if it doesn't do it to tomorrow. In other words, it closes on the high today, but tomorrow they just start selling it and they take it below today's open. They're going to get nervous of some kind of 2-day negative reversal. They're going to get concerned. It's just a knee-jerk reaction. Day trading, people getting carried away, and they're betting against what was bearish data today. Okay, so I just cannot trust this, and I don't know how to explain it well enough here, but I do not trust the upside. I do not think, even though I realize I said there's going to be a bounce in October for level 2, and this may be it. The point is the level 2 bounce could be all over by next week. If I'm wrong on it, it'll probably be over by the end of the month, early next. Maybe that could get us up to 3,900 area. Okay, so I'm trying to give you ideas how high it can go, what can go right or wrong for the bull side, but I just want to warn you on the bear side, there seems to still be more time, more patterns, and more possibilities to the downside, and we know there can be downside objectives, 3,400s into the upper 3,200s. We know some of that could delay for weeks yet, but it can occur, and we know with today's information, nothing's really changed. But what's weird is we're still split. There's still some confusion because, again, if we don't talk about the war on inflation, if we don't talk about interest rates, if we don't talk about inflation, period, okay, then all that's left is what are the businesses doing? And these businesses are making money. Some are backing off, some are getting hurt, and we'll know more of that in the next couple of weeks probably. But they're doing well. The economy's doing well. That's why inflation's so high. It's doing well. That's why jobs creation is so high, and the government's really getting nervous over that. They want those jobs to come down. They're not seeing the evidence of this. And I think the PMIs are telling us the truth, that we're not in a recession, that the negative GDP earlier this year was not telling us the correct story, what's going on in the economy. It's actually the PMIs that are telling us. But that doesn't mean damage won't be done down the road. That doesn't mean something in China and Europe can't blow up on us and cause us problems for ourselves, and very well can cause problems for ourselves, period, by raising these interest rates too fast. So at any rate, I'm pleased for the bulls. I'm happy for them right now. I'm guessing they're getting back in. They're scared of missing out of something, but I'm just a little concerned somewhere's near 3,800 on up to about a little over 3,900. Somewhere's next week on to later this month, it's all just going to fizzle out for them, and the market's coming back down. I think we're still at risk. I think this is a knee-jerk reaction, and I don't think it's what we need for sustainability and tractability. Okay, well, I've said enough. Feeling pretty tired. We will reevaluate tomorrow, obviously. Need to see how it closes today. What do they want to do overnight? Well, how will they behave going into the weekend? Past results and unnecessary indicative future results. By the way, I don't see a whole lot for the global markets. They're just going to follow the U.S. around. I don't see a whole lot for things like oil markets. They're concerned of a poor economy and continuing to fight on inflation. Dollar index looks soft, like it can go lower into next week, and maybe the interest rates can go lower, and maybe that's what's going to help pop the stock market a little bit. But my guess is looking out towards November, we got higher rates coming. And I'm just thinking, why wouldn't the stock market go down? Thank you.